Hello. Today we're going to be talking about the new tax strategies for tangible property that have come about as a result of the recent tax reform that I'm sure everyone on paying attention to this is familiar with. But on December 22nd, President Trump signed into law the most sweeping changes to taxes since 1986. And with those, there are a number of tax changes impacting tangible property, and we're going to be talking about those today. Need to first get the legal messages out of the way, so I won't read this, but assume that everyone on the call can read. And that's probably just about enough time to get through that. Okay, my name is Jeff Shilling. I lead the Tangible Asset Incentive Services practice here at Moss Adams. That is anything and everything having to do with depreciation, deductions, or expenses associated with tangible property. Been doing it for about 30 years, and so have developed an in-depth knowledge of tax laws related to fixed assets, repair and maintenance, depreciation, real and personal property transactions in a variety of industries. And with that, we will get on to the presentation. I'm going to be talking about the most impactful areas for tangible property included in the tax reform, specifically bonus depreciation, Section 179, expensing, improvement property, some other noteworthy provisions that are worth mentioning, and then the opportunities and benefits that taxpayers will want to avail themselves of associated with these changes, and some tax deduction strategies, or some strategies to increase tax deductions to best take advantage of the opportunities and benefits. So first of all, I think probably what everyone's heard about or most familiar with is the changes to bonus depreciation. For assets acquired after September 27th, 2017, bonus depreciation has been increased to 100%. So assets can be written off in the very first year of ownership. That's for, as I said, after September 27th. It was previously 50% and scheduled to phase out over the years 2018 and 2019, dropping 10% per year, with none after 2019. With the new 100% bonus depreciation that will be in place for the next 5 years, but then will decrease in 2023 to 80%, 60% for 2024, 20% thereafter through 2027, and no depreciation available for 2027. For companies that may have completed tax planning around their purchases and want to maintain the 50% as they had planned for the period of actually the first year following September 27th, for year ends following September 27th, they can elect to take just 50% bonus depreciation rather than 100%. So it's not required, and also the rules allowing you to elect out of bonus depreciation for any particular class of assets within a tax year, those are still available as well. The other thing to note about on this slide, this asterisk, for long production period property and certain aircraft, these bonus thresholds or sunsets get extended 1 year. So they've also expanded the property that's eligible for bonus, as we'll continue talking about. So qualified property, that is the property to which the new bonus regulation or new bonus code applies, that which can take the additional bonus in the first year of ownership, additional depreciation in the first year of ownership. The definition's been expanded to not only newly acquired or first time used ever, it's been expanded to used property, or that is property in its first use by the particular taxpayer. There are some rules around this to make sure that members of consolidated groups or related parties aren't trading property back and forth, but other than that, other than those specific exclusions, used property now qualifies for bonus depreciation as long as it's acquired in an arm's length transaction. And this is all property with a maker's life of 20 years or less. Also included is certain computer software, as long as it's subject to depreciation under Section 167. Water utility property, definition of qualifying property has been expanded to include qualified film, television, and live theatrical productions. Also, the rules were clarified around bonus depreciation and its applicability to fruit or nut-bearing trees and vines to clarify that bonus depreciation is available for those assets. It does not apply to property used in motor vehicle sales if that taxpayer is including floor plan financing costs in their interest deduction. If they can choose to take bonus depreciation and not utilize the added interest deduction from floor plan financing, but if they do include that in the interest deduction, they're not allowed to use bonus. Improvement property is worth talking about as a separate topic because, quite frankly, mistakes were made in drafting the new code around improvement property. It's very clear that the intent of the congressional conference that created the agreed-to code between the House and the Senate, that the intent was for improvement property to be 15-year property and have it qualify for bonus depreciation. Instead, what happened with the way the new code, the public law, got written is that the definition for qualified improvement property was removed from the area of the code that qualified it for bonus depreciation. Previous to tax reform, it had a 39-year life, but qualified for 50% bonus. They removed it from the bonus section of the code, transferred it to the general definition or specific definition area of the code, failed to include it in the 15-year life table, and also failed to include it in the table of qualified property for bonus. So what that means is that we have to live with qualified improvement property going forward being 39-year property and not qualifying for bonus until such a time as a technical correction can be made. However, given that a technical correction bill requires more than a simple majority to pass, the likelihood of that in our current Congress is slim to none. Your guess is as good as mine as to when, if ever, that could happen, given other changes, attempted changes that we've seen to past laws or recent laws. And not only did qualified improvement property get written in or failed to get written in for 15 so it retains its 39-year life, but they did away with the definitions for qualified leasehold improvement property, qualified restaurant property, and qualified retail improvement property, all of which were under the previous code 15-year categories that taxpayers could avail themselves of. Those are now gone. There is no 15-year qualified property, as we said, until changes were made. So this is going, as we'll see in the next couple of slides, there are other opportunities associated with qualified improvement property, but this is something that taxpayers that use this category or use the 15-year qualified categories in the past will want to do a little extra thinking around because it's no longer available. Section 179, expensing, the deduction for expensing of property that falls into the 179 definition has been expanded. The thresholds, first of all, were increased. And for those of you, Section 179 expensing applies to tangible personal property or tangible property used in a trade or business, can be new or used. and allows for 100% expensing rather than, it's different from bonus depreciation in that bonus depreciation is an additional depreciation that's taken against the asset required of, or irrespective of basis, whereas under Section 179 expensing, up to these thresholds, amounts can be simply expensed. And those thresholds, as I said, increased from what was $510,000 in 2017 to $1 million in 2018. And the reason we refer to it as a threshold, because for taxpayers that have purchased more than $2.5 million per year, it used to be $2,030,000, but for purchases in 2018 of more than $2.5 million, there's a dollar-for-dollar phase-out of the amount that can be expensed. And one might think, well, isn't that just the same as, don't you get the same effect through bonus depreciation? And that's generally true with the exception of qualified improvement property, because the definition of what can be expensed under 179 has been increased to include qualified improvement property, which is otherwise, as we said, going to be 39-year property. So this is a great benefit given the mistake that was made, that up to the limits and the phase-out threshold, you can deduct qualified improvement property as an expense. In addition to, and the definition, as I failed to recite it earlier, qualified improvement property are improvements made to the interior portion of a building after the building was first placed in service that do not represent structural members of that building. So interior improvements, not an expansion, not walls or roof, and completed after the building was first placed in service. In addition to the qualified improvement property qualifying under 179, there are other certain non-residential real property improvements. So this doesn't apply to residential rental, but non-residential real property improvements that also qualify under 179, specifically roofs, HVAC, property, fire protection, alarm systems, and security systems. So many of these systems also qualify under QIP, those that are interior to the building, but just to make perfectly clear, they wrote these specific improvements and no others, so it's also an exclusive list. And then also under 179, the definition of what can be deducted was expanded to include personal property used predominantly in lodging, which historically was excluded. So more benefits under 179. Also related to 179 and bonus depreciation, the limits under 280F, generally referred to as the luxury automobile provisions, have been increased. $10,000 for the first year is what that new limit is. In the first year that it's depreciated, $16,000 in the second, $9,600 for the third, and $5,760 in the fourth and last years. These limits, as well as the $25,000 sport utility vehicle limitation limits and the threshold limits for 179, beginning for years after 2018, they will be indexed for inflation. So they will continue to grow versus being set limits that had to be reset in the past. So that's also beneficial. Some other noteworthy provisions that are important to taxpayers with tangible property. Like-kind exchanges are now limited to real property. So in the past, there's been controversy, not perfect understanding of what could be included in the real property exchange, where there might be personal property embedded in the real property. So rather than continue that controversy or have that open for controversy, the code tax reform included this rewrite of the 1031 exchange rules, which say specifically limited to real property. Any personal property included would need to be carved out or would be subject to boot if it were included. So it would have to be, it's not going to be part of the tax-deferred transaction. It would be a separate taxable transaction. The only exceptions to the new rules, as indicated here, was where one leg of the exchange had been started prior to the end of 2017. So if you're finding a replacement property prior to getting rid of the property and had completed that leg, or if you had disposed of your property that you're going to trade through the 1031 exchange, either one of those actions would keep the old rules available for you until the deadline hits or until you complete your 1031 exchange. Also had a couple of recovery periods. These are the most noteworthy. There were several others, but for folks most likely to be listening to this, we thought important to let you know farming business machinery equipment is now recovered over 5 years versus 7. And the alternative depreciation system, ADS life, for residential rental property has been reduced to 30. Many of you will recall that for non-residential real property, the depreciable life under ADS is 40, whereas the general depreciation system, the one most used, is 39. Those two seem to line up. However, when you went to residential rental property, the ADS was still 40, and the GDS life was 27.5. General depreciation system life, 27.5. Those two have now been brought into greater conformity with this change. So what's all this mean from an opportunity standpoint? These are the rules that we have to live with going forward, but we have a unique opportunity for the 2017 tax year. And that unique opportunity is related to the difference in tax rates. So right now, the top marginal rate, so if you're a high earner and can take deductions, those deductions at the marginal rate of 39.6 are essentially worth a tax deferral, given that these are timing differences. The total depreciation that you can take is not going to change. The timing that you can take by moving something from 39 to 5 years or 39 to 15 years, it's the timing that changes. So we don't refer to this as a savings, we refer to it as a deferral. The deferral under the old rate is $39,600. That same $100,000 additional deduction next year, assuming your top marginal rate of 37% with 20% income deductibility, a lot of rules around that, and that's outside of the scope of this presentation going through that, but we do have other presentations out there that anybody that's worried about the definition of qualified business income, you'll want to avail yourself of that learning opportunity. But in 2018, that same deduction is only worth $29,000. So for any additional deductions that we can drive in this tax year in 2017, you're creating a permanent tax savings of $10,000 for every 100 grand, as indicated in this somewhat simplified example. This doesn't include the time value of money from one year to the next, and we're not, not everyone's going to qualify for all of that 20% deduction. However, it does present very simply that any deductions taken in 17 are worth much more than they will be in 2018. So we'll want to look at any methods or strategies that can increase deductions into 2017 or defer income into 2018. And what many taxpayers don't understand is that for assets placed in service prior to 2017, we can complete, or the IRS allows, automatic accounting method changes that allows you to catch that depreciation up all in the year of change, as we'll explore a bit further. So what are some ways that we can drive additional deductions into 2017? One of the most often used strategies is referred to as cost segregation, which is simply the reclassification of assets out of 39 or 27.5-year property into 5, 7, or 15, front-loading the depreciation or greatly increasing the depreciation in the early years of real estate ownership. And that's identifying things like carpeting, electrical that specifically serves personal property assets, HVAC that might be cooling just a computer room. Those assets or portions of the property that are so closely related to the personal property or the business that's being conducted in the building that it can be classified as personal property. And this applies to whether we're talking about new construction, brand new building, greenfield, improvements made to real property, remodels, expansions, or purchases. Can avail, taxpayers completing these kinds of projects can avail themselves of cost segregation. And as we talked about, significantly shorten the tax lives, significantly increasing the depreciation, and that increase, or that missed depreciation, or those depreciation increases can be gathered up from past years and all taken in 2017. So in many cases, projects for people that are aware of cost seg, or cost segregation, that thought were maybe too small, this would be the year to gather those all together and take advantage of them at once and lock in those permanent, that permanent tax difference, which can be described as tax savings and permanent. Another opportunity, fixed asset consulting. So rather than focusing on large one-off projects, a building purchase or a significant expansion, what we do here, or what is done here is, and suggested, is a review of your fixed asset records to ensure that historic expenditures were classified properly. You took advantage of bonus depreciation that might have been available for qualified leasehold improvement projects, and making sure that that qualified property was properly classified into its 15-year life instead of 39. Also, missed bonus depreciation, making sure that you took advantage of that wherever it was available, and also asset retirement. So if you've got a fixed asset record that you know doesn't necessarily represent the tangible assets that you actually still have, now would be a good time to go through it and identify those assets that are gone, any remaining book value or any remaining value, net book value that is associated with those assets would get written off in the year that they're identified. Again, increasing deductions in 2017. And finally, the last strategy we were going to talk about is associated with the tangible property regs, often referred to as repair regs. They became effective in 2014, and many taxpayers have modified their accounting methods and or records associated with the opportunities under the tangible property regs, and we continue to find taxpayers that have not gotten up to speed yet or not fully modified their procedures and practices. The biggest opportunity here is for those expenditures that, due to the length of time that you've owned the property or the nature of the expenditure, could be expensed rather than capitalized because they're more in the nature of a repair, and also where you have capitalized something because it does represent an improvement. Did you go back and look at what that replaced, and is there a partial disposition? This is only going to work for current year assets or current year additions, but was there a partial disposition that you could take for the remaining value of the asset that was replaced? And so it's a good idea to review current additions to see if any of those can be reclassified as repair expenditures. So those were the primary strategies. Those are the primary changes that were impacted, or the impacts on tangible property as a result of tax reform that we wanted to talk about. The key takeaway here is, as we just spent the last bit of time discussing, maximize deductions in 2017 to lock in those permanent changes, or to the extent that you can, now that we're in 2018, push income into 2018. Probably a little difficult to do that at this point, but if you could, that would be a good idea too. Thank you for your time today. If you have any questions, feel free to contact me, Jeffery Shilling at mossadams.com, or by telephone, or through the Moss Adams website, mossadams.com, and contact myself or any member of the TASE team, Tangible Asset Incentive Services. Thanks for your time.